The contagion from the collapse of SVB, Silicon Valley Bank, continues till today. And I'm going to show you some information that will unfold in the events of this week. You need to pay attention to what I'm showing you here because that's going to make a lot of sense as the details unfold. We are only just beginning to peel back all those layers of the onion to find out what's underneath. And this information I'll cover will be integral to all of that. It's going to be explained right here. I'm going to show you the details as I've been covering these issues with SVB and the other banks that have failed, why that has been the case. I talked about that in the previous videos and I will link them in the description. And then of course, I'm going to show you why this is important, what you need to do as well. And I'll expand on that in future videos here. The very first thing is about Jimmy Boy Cramer, who said it is easy for any of us to cause a run on banks. Well, not exactly, Jim. You know, you got to watch your words. He had said just a month ago, this is the bank to buy. Now he's getting a little bit in trouble because this was a kind of a Bear Stearns moment. But this is the key. Look at this. Financial market stress indicators reacted sharply on Monday after a failure of 3 US banks within 5 days. I'm not sure if you're aware. If you haven't been covering it exactly, you would maybe not know that now we're at the 3rd bank within 5 days, which prompted a rethink among investors on the outlook for US rates and triggered the biggest rush into bonds since at least 2008. When investors are buying into bonds, they're looking for a guarantee. They're buying those bonds thinking that it's going to pay them a return. Well, as a result of that, we saw the prices collapse. I'll show you the details. I'll give you the charts on that. But you can see the sentiment immediately changed. Why is this happening though? Well, it's not just, they're concerned. It's the fact that the Federal Reserve is now expected to not only stop all that which they're doing here, but actually cut rates in 2023. This is incredible, to say the least. When I look at this, I mean, it's been unbelievable. Over my head over here, you could see that's the bank index. The financial stocks are getting punished right now over the last several days as a result of all of this. First Republic dropped 60%, leads the decline in bank stocks despite government's backstop of SVB. That was one headline, but it actually got worse for First Republic. I just wanted to show you that. Along with this, Credit Suisse shares fall to new record low after collapse of SVB and Signature Bank. All these things are propping up all over the place. But what's the big news? I'm going to give it to you right here and now. Regional banks are seeing flight of deposits to too big to fail mega banks. That's the number one aspect. So what's going on here? The regional banks are losing out to the big boys, to the JP Morgans, like I covered in the video maybe a day or two ago. I said, who is going to win as a result of this failure? And it is very clear that the big boys like JP Morgan are doing so. Investors are dumping regional bank stocks despite a fresh federal backstop. The government's saying, you don't have to worry. We're going to come in. We're going to take care of it. And yet, do people really trust the government? Of course not. They don't do that. So they're pulling it out and they say, hey, my money is definitely going to be safer with JP Morgan. And so I'm just going to put my money there. Why not? First Republic Bank said it would receive liquidity from the Federal Reserve and JP Morgan to bring its total liquidity up to $70 billion. That's just one case right there. And that's, in my opinion, an example of when you know that these big institutions are equally as powerful as governments. That's when you know this. It's very interesting to see that during a failure, you have some of the biggest companies in the world that suddenly extend their hand. But this is the one that I wanted to show you linking into that, which is key lender to regional banks aims to raise $64 billion via bonds. Why would they do this? Do they expect more failures? You only do this in a circumstance in which you believe the failures will continue. This is not going to send a good signal, right? Because the players on the inside are going to see this and realize what's up. Securities sale comes as U.S. banking sector concerns spread. Quote, this isn't the normal size for sure. I'm going to repeat that. This isn't normal. You don't just go out there and raise $64 billion. This is telling us that they expect more and more and more failures. And some might say, well, so what? Government's just going to backstop it. I don't think they realize, take themselves just a minute, that companies failing, especially those in the financial industry, have ramifications and knock-on effects that are going to be felt throughout the system, and you could have that actually, tumble things down. It's not a simple matter of, well, you don't worry, because the Federal Reserve is just going to print some money. It's going to fix it all. The inflationary forces that are going to take hold as a result of this. Imagine where inflation is today, and they're ready to print a lot more money. They're not going to take care of inflation. Inflation's going to run hot. Inflation's going to run hotter than you thought. And that is going to make a very, very serious problem for the average person, the middle class. Let's move on, okay, to this next aspect of it, which is the U.S. system of federal home loan banks, ramping up the amount of cash it has available to deploy as the failure of several bank lenders, including SVB, stoked expectations that more regional lenders will need to tap it for funds. The FHLB system, a key source of cash for regional lenders, is seeking to raise about $64 billion through the sale of short-term notes. This, my friends, is where it gets so interesting. This isn't a normal size for sure, but it likely reflects bank funding needs given the backdrop. I don't think they'd be doing what they're doing if there wasn't a real bank demand. This is so key. It's unbelievable. Think about what we saw just recently, something that I covered. There was concern about Credit Suisse. This is a bank. What's happening to it? Are they failed? What's the concern? There was all this concern around it. And then we saw the Swiss National Bank, the central bank of Switzerland, suddenly require a lot of US dollars as part of a currency swap. And they took up, I think it was $11 billion or even more at one point, which, by the way, just to give you in context, is like historically extremely high. You hadn't seen that since the financial crisis. And they needed that currency. Basically, they needed US dollar, a lot of US dollar in a short period of time because the bank was dealing with so many problems. One after the other after the other. And now it's at a record low. This is one company of many, and they're not necessarily even directly tied to SVB. You have to understand, it's not SVB that's the problem. It's not a simple matter of the government waving its magic wand and saying SVB has been resolved. It's not just the three banks that have failed. This is an absolute fact. When you take an alcoholic and you take that alcoholic and you rip away its alcohol from him, what do you think you're going to do? Is it just going to be like, well, okay, that's just a matter of fact. I don't have any more alcohol and everything's okay. No, they have withdrawal symptoms. They deal with the problem very bad. They lash out. These things are happening right now. That's underlying all the system. The government's going to tell you everything's fine. The government's going to tell you everything's A-okay, but you're going to have to pay through more inflation. And if people aren't willing to realize that, you've got a big issue coming up. Do you think that they're going to sit there and watch all the banks one after the other collapse? Some will happen. Look Bear Stearns. Look at what happened with Lehman Brothers. These things really, really became a big problem. Of course, the government could have stepped in earlier. Oh, but the reason they did that was to create an additional crisis. They create the crisis, they exacerbate the crisis, but then they come in when they think it's right. And then we get the inflation afterwards. That inflation benefits usually the special interests and those multinational conglomerates. JP Morgan already stands to gain from what happened here. They've already gained. Do you see where I'm going with this? This is huge. This is massive. They're setting up for more failures. Those failures are not going to be fixed overnight. And so we could see the ramifications of this in the coming days and weeks. So please pay attention. Hit that subscribe down below. And I'm going to bring you the latest and greatest info with no fluff. Let's go on. Here we have it. SVB collapse. Bank fallout shines a spotlight on the $620 billion hole in the banking sector. What are we talking about here? Well, this is something that I think people should know about. They say right here, look, the whole illustrates why the authorities at the Fed, the Treasury, the FDIC were so eager to stave off contagion and panic and spread from SVB's demise across the banking sector. What's going on? Well, how does this work? Look, I could show you in this chart, unrealized gains and losses on investment securities. So the blue area is the held to maturity securities. And then there's the green, which is available for sale securities. And all this while has been in the negative, billions and hundreds of billions of dollars right now. And so they explained it right here. SVB's meltdown was partly caused by a chasm between its assets and what they were worth in the market. Eventually, SVB sold some of those assets, spooking investors and triggering a run on the bank. But SVB isn't alone, as banks across the United States were sitting on $620 billion in unrealized potential losses at the end of last year, according to the FDIC. Do you see what's going on here? This is massive. This is much bigger than what we're being told. They have to backstop this immediately, or we're going to run into the financial crisis part 2 officially. And they're going to tell you everything's fine. But I'm here to tell you the truth. That's why you came here. You came here for the truth. This is another chart basically showing a simple thing, but breaking it down by bank. $620 billion of unrealized losses. Overall equity, $2.2 trillion. If a run on the bank would happen, it could be fatal even for several large US banks like JP Morgan and Citi. This crisis isn't over. The US Treasury simply bought some time. That is true. They did so. And I think, they're trying to do what they can for the, people on the inside. And we don't really know what's happening in depth, but we do know this. And it isn't good. It isn't pretty. Do you see what I'm saying here? They're setting up for losses. We can see the numbers. So they're literally preparing. I've just showed you they are preparing for major losses. And then we look at what has happened over the last few years. I've given you all the evidence, and now we know. We know what's happening, and we're going to feel this in the coming days. You watch this part of the video, and you are aware of that. I hope the others are covering that as well, because people need to learn about this. By the way, the channel has been growing right now, and I want to say hello to each and every new subscriber. Thank you very much for being here, okay? This is really, really interesting stuff. At least 20 regional banks have been gripped by turmoil as fears caused by the collapse of SVB spread. You remember what I was saying earlier? This isn't just 1 or 2 or 3 banks. We're now talking about many others. They're talking about Western Alliance Bancorp, Zions Bank Corporation, and others. There are many. Even the stocks in Europe are taking a hit right now. Look at some of the examples here. Most banks are solvent under normal circumstances. The problem is pretty much no bank can withstand a full bank run. The FDIC action removes the idea of a deposit bank run, but what we're seeing is an investor bank run. Do you see what's going on here? You see, people can go and they can pull that out, but the Federal Reserve is basically working with the FDIC. They're saying, no, we're going to take care of it. No matter what, you're not going to lose your deposits. And that's great. As an individual, I would never recommend, by the way, having more than $250,000 in an account. And why would you even keep $250,000 of cash in there unless you were prepping to then go buy an asset? I could understand that for like a short period of time. But anyway, this just highlights the fact that they are doing this, but it doesn't resolve the underlying issue. Let me show you some of the examples. First Republic Bank sank 79% for a record drop, sparking multiple halts in its volatility. Western Alliance Bancorp lost 85%, biggest drop ever. PacWest Bancorp are down 60%, record low, on and on and on. Do you see what's going on here? Many, many, many different companies. And that's why I showed you with the bank index is just basically getting slaughtered at this time. And that is having other effects as well, even on cryptos. US crypto firms seek Swiss banking partners amid banking meltdown, one after the other, after the other. And I don't think that this will be resolved anytime soon. I've shown you the knock-on effects, the domino effects, and this is all taking place right here, right now, today. I try to bring as fast and concise as possible. If you appreciate that, please let me know. I want you to share this video on your Facebook. That's what happened in a couple videos ago, where the views started declining, and then this thing got shared on Facebook and the views surged up. We've got to do this, get the word out. I do appreciate that very much. Any of your social medias, let's get it out there. Let's get this out to the people. I want to thank you for being here, and I'll see you on the next one. Take care.